Welcome back to The Deep Dive. If you're looking for that shortcut, that insight into the big strategic plays in global finance, well, you're definitely in the right place.
Absolutely.
Today, we're zeroing in on China, specifically how it's trying to connect its huge domestic stock markets with the rest of the world. We're talking about the Stock Connect initiative.
Yeah, they call it a pioneering initiative, and it really is more than just, a way to trade stocks. It's this institutional bridge.
A bridge. How so?
Well, it's highly strategic, designed to create this permanent, but importantly controlled, two-way flow of capital. Between mainland China and Hong Kong, it's international finance gateway.
Okay, controlled is the key word there, I imagine. So our mission for you listening is clarity. When we finish this deep dive, you should really get a handle on a few key things.
Right, like how Stock Connect has actually performed strategically over its first, decade now.
And this fascinating puzzle.
Yeah.
Why shares in the exact same company can trade at totally different prices in Shanghai versus Hong Kong. The discount dilemma, as we're calling it.
Yeah, that A-share gap is persistent.
And finally, we'll dig into that big debate. Can China's stock market realistically ever match the, let's say, vibrancy and depth of Wall Street? Or are there fundamental limits?
And we've got some good material for this. Reports detailing the Stock Connect's success metrics, some really deep analysis on those A versus H share price gaps.
And importantly, those competing arguments about China's market future, right? Especially with this recent AI-driven rally that seems very selective.
Very selective indeed. We'll unpack that too.
Okay, let's start at the beginning then. The foundation. Stock Connect officially kicked off with the Shanghai-Hong Kong link November 2014.
And then Shenzhen was added later.
Yeah.
And pretty much everyone agrees it's the world's leading model for this kind of two-way market opening, especially given, the complexities involved with China.
Right, those complexities, the
Right.
constraints. You mentioned it's controlled. Talk a bit more about that.
So the core purpose is twofold. One, let international investors get access to mainland A shares. That's what we call northbound trading.
Okay, money flowing north into the mainland.
Exactly. And two, let mainland investors access Hong Kong-listed H shares. That's southbound trading.
Money flowing south out of the mainland into Hong Kong's market.
Precisely. But the genius, or maybe the necessity of the design, is how it works around China's very strict capital controls. And the fact that the yuan, their currency, isn't freely convertible.
Ah, okay, so it's a workaround.
It is. It was specifically built to bypass that whole issue. It functions more like a controlled valve,
Yeah.
rather than just throwing the doors wide open.
A valve, not a floodgate. Makes sense.
Capital moves, yes, but only within set limits,
Yeah.
daily quotas, and under pretty intense regulatory watch,
So Beijing gets the benefits of internationalization.
without giving up control over their currency or risking massive capital flight. They could move forward on opening up without that full, potentially destabilizing currency liberalization.
Okay, so this valve. How much of the market are we actually talking about? What's the scale here? It's huge now. The eligible stocks covered by Stock Connect, they represent over 90% of the entire A-share market cap.
Wow, 90%. So essentially, the vast majority of China's domestic market, the second biggest in the world, is accessible through this Hong Kong channel.
That's right. It's a massive amount of access they've granted, albeit controlled.
And controlled via those daily quotas you mentioned. What are they currently?
Last figures I saw were around RMB 52 billion daily for northbound. So foreign investors buying mainland shares.
Okay.
And RMB 42 billion daily for southbound mainland investors buying Hong Kong shares.
That's a lot of potential capital flow being managed every single day.
It really shows the scale of the capital pools they're connecting. But what's interesting in the growth numbers is the enthusiasm from mainland investors.
For the southbound route, going into Hong Kong.
Exactly.
Yeah.
Southbound trading saw a really impressive compound annual growth rate, about 15% between 2017 and 2023.
15% CAGR. That's significant. What does that signal? It signals real organic demand from Chinese domestic investors. They want to diversify. They want access to that slightly more open international environment in Hong Kong.
So that 15% growth, what's the impact been on Hong Kong itself? Big boost to liquidity.
Oh, absolutely huge. For Hong Kong, Stock Connect has been, frankly, foundational for its modern role. It cemented its position as that critical bridge between China and the world.
The key international financial center.
Yes, deepens liquidity there, definitely.
Yeah.
And crucially, it's helped accelerate the international use of the renminbi, the RMB. Hong Kong is by far the largest offshore RMB hub because of mechanisms like this.
And on the flip side,
Huh.
for the mainland, it's not just about money coming in, right? There's an institutional effect.
Correct. It's been a powerful catalyst for internationalization within China. It sort of forces upgrades to their financial infrastructure.
Yeah.
Well, it led to follow-on innovations like Bond Connect. It paved the way for new products, things like green bonds, ESG investing becoming more prominent. Plus, having sophisticated foreign investors involved tends to push mainland companies towards, better corporate governance, more transparency.
Which is vital for long-term market health.
Absolutely. So institutionally, in terms of building the plumbing, Stock Connect is widely seen as a major success.
Okay, so the plumbing works. The infrastructure is successful. But that brings us right to that strange market dynamic we talked about. The pricing.
The discount dilemma. Yeah.
Let's unpack this disconnect between the mechanism working and the actual prices.
It's the core contradiction, isn't it? You have these companies dual listed. They have A shares trading on the mainland, Shanghai or Shenzhen,
Right.
and H shares trading in Hong Kong. Same company, same underlying business. But the prices, often very different.
And there's an index tracking this.
Yes. The Hang Seng Stock Connect China AH Premium Index. And historically, what it shows is that the H shares, the ones in Hong Kong, often trade at a significant discount compared to their A-share twins on the mainland.
Okay, hold on. It's the same company, same claim on future earnings, same assets. Why would one share certificate be significantly cheaper just because it's listed in Hong Kong instead of Shanghai?
Yeah, it seems counterintuitive, right? But it comes down to a mix of factors: regulatory, structural, even psychological.
Like what? Who's buying these shares?
That's key. The mainland A-share market, dominated by domestic retail investors, millions of them.
Okay, and their behavior is different.
Generally, yes. Often shorter investment horizons, maybe less focused on global corporate governance standards, more influenced by immediate domestic news or policy hints, sometimes just momentum.
So they might be willing to pay a premium for familiar local names regardless of underlying global valuation metrics.
That seems to be part of it. Now, flip to the H-share market in Hong Kong. Who trades there?
More international institutions, global funds.
Exactly. Big global funds, pension funds, sophisticated international banks. And they apply much stricter criteria, especially around risk.
What kind of risk?
Governance risk, regulatory risk, policy uncertainty risk. They demand higher levels of transparency, predictable rules, shareholder rights, things like that.
Got it. So if a company, especially maybe a state-owned one, is seen as having potential political interference or opaque practices?
The international investors just build in a bigger safety margin. They apply a discount. That's the H-share discount. Fundamentally, it's a risk premium.
Makes sense. Where do we see the biggest discounts typically? Which sectors?
You see it really clearly in sectors like financials, banking especially.
Yeah.
Because they're so sensitive to local mainland policies, monetary decisions.
Right.
Also big industrials, materials, energy sectors, and particularly the massive state-owned enterprises, the SOEs. They almost always trade at a discount in Hong Kong versus the mainland.
Because foreign investors assume they might prioritize government mandates over pure profit maximization for shareholders.
That's the standard interpretation, yes.
Yeah.
That discount reflects the perceived risk of policy changes, lower transparency sometimes, and just fundamentally different governance expectations compared to, say, a Western multinational.
Are there other factors? Liquidity?
Yeah, that plays a role too, though maybe smaller. Some H shares might have lower trading volumes than their A share counterparts, which can affect price discovery. But the big driver is that perceived policy and governance risk differential.
Okay, so that structural risk, that policy uncertainty, it really highlights why those huge capital flows we discussed earlier through Stock Connect are often described as fragile.
Totally fragile. Yes, the daily turnover, northbound particularly, is enormous, averaging around RMB 136 billion recently. That's huge volume. But sentiment can flip incredibly fast. Just look at the second half of 2023, between August and December. Northbound flows saw net outflows of about 187 billion CNY.
Wow. 187 billion yuan flowing out in just a few months. That sounds like a lot. How does that stack up historically?
It's massive. That outflow represented almost 10%, 1/10 of all the cumulative northbound money that had come in since Stock Connect started back in 2014.
10% wiped out in less than half a year.
Yeah. It just shows how sensitive international capital is. When perceived risks rise or economic disappointment sets in, that institutional money doesn't hesitate. It can move very, very quickly.
And how did the authorities react to that kind of volatility, that outflow?
Well, sources noted that there was action taken regarding the real-time northbound turnover data,
They limited access to it or removed it.
something along those lines. Limiting transparency around those flows, it was seen as a pretty clear move to try and manage market sentiment, maybe reduce panic selling by making the outflows less visible in real time.
Right. It just underscores that point again, doesn't it? The bridge exists, the flows are huge, but the regulators are still very much in control. They have the blueprints and maybe the off switch too.
Absolutely. That controlled valve metaphor holds true.
Which brings us, naturally, to the really big question, the one debated constantly in finance circles. Can China's market, with this level of state oversight and these structural issues, ever really achieve the kind of, let's call it vibrancy, the depth, to genuinely rival the U.S. markets?
It's the multi-trillion-dollar question, isn't it? Because it dictates long-term global capital allocation.
Yeah.
We should probably look at both sides. Let's start with the yes case, the bulls.
Okay, the upside argument. What's their core pitch?
It really rests on scale and strategic shifts.
Yeah.
First, obviously, China's the world's second largest economy. That's just a fact.
Can't ignore the scale.
And second, they point to genuine, world-leading innovation happening in specific strategic sectors. Think EVs, green technology, and critically, artificial intelligence, AI.
Right, they often highlight things like specific AI models, like DeepSeek R1 was mentioned, as proof that the tech base is strong, regardless of, say, geopolitical tensions.
Exactly. The argument is the corporate dynamism is there, especially in these new economy areas.
Yeah.
And then there's policy support.
How so? Explicit support for stocks.
Well, you've seen reforms, like the Star Market, Shanghai's Tech Board. The goal there is partly to rebalance the economy, shift corporate funding away from so much reliance on bank debt, which carries risks, towards equity financing, more like the U.S. model.
So fostering an equity culture, basically.
Trying to, yes. And when the market really falters, we've seen the central bank, the PBOC, step in, actually buying domestic ETFs.
Putting a floor into the market.
Effectively, yes. Signaling state support, trying to prevent outright panic.
But doesn't that intervention itself raise questions? Is it propping up something that isn't fundamentally healthy? That's what the bears would say, right?
That is absolutely the counterargument. But the bulls have a comeback. They'd point to changing corporate behavior. Like in 2024, we saw record levels of share buybacks by Chinese companies.
More buybacks, meaning companies returning cash to shareholders.
Exactly. Buybacks actually exceeded the amount of money raised through new equity issuance for the first time ever, apparently. That suggests a potential shift, maybe companies starting to prioritize shareholder returns more. That's a sign of market maturity.
Okay, interesting. And valuations?
Valuations look attractive, on paper at least. Price-to-book ratios, for example, are below historical averages for many Chinese stocks. So the bulls see scale, innovation, policy nudges, improving corporate behavior, and cheap prices. That's the optimistic case.
Okay, compelling points. Now let's flip it. The other side of the coin. The structural drags. Why might China's market not reach that U.S.-level vibrancy? What's the no case?
It really boils down to trust, institutional trust, and domestic constraints.
Unpack that. Trust in what?
Trust in the system. The anti-China, or maybe just the more cautious argument, centers on the history of unpredictable government interventions, regulatory crackdowns that seem to come out of nowhere.
Like the tech sector crackdown a few years ago.
That's a prime example. And the continued dominance of those huge state-owned enterprises, the SOEs. Global institutions worry that policy goals can suddenly override shareholder interests. That unpredictability makes it hard for long-term global capital to commit fully. The rules feel like they can change.
So policy risk and governance concerns remain paramount for foreign investors.
Absolutely. And then you have to look inside China, the domestic investor base. We talked about retail dominance.
Right. Still very focused on property, maybe cash, less on long-term equity investing compared to the West?
That's generally true. The average Chinese household is still quite risk-averse, especially after the recent property market turmoil. Plus, household debt levels are relatively high.
Which limits their capacity to pour savings into the stock market.
It potentially limits the growth of that deep, stable, long-term retail investor base that helps cushion volatility in markets like the U.S. And then, of course, there's the whole geopolitical layer.
Can't escape it. U.S.-China tensions.
Yeah, the trade disputes, the tech restrictions like chip export curbs, potential future tariffs. It's a constant background noise, a significant headwind that just dampens enthusiasm and adds another layer of risk.
So it feels like any innovation, any positive momentum has to fight against these quite significant structural headwinds.
That's a good way to put it. And that dynamic, that tension, is perfectly captured by what happened with the recent AI-driven rally.
Ah, yes, the selective rally. Tell us about that. It wasn't a broad market recovery, was it?
Not at all. It's a really clear window into how investors are thinking right now. You saw offshore Chinese stocks, particularly tech names listed in Hong Kong, rally hard, maybe up nearly 40% from their lows around September.
Okay, a strong bounce. But what drove it?
It seems it was almost entirely valuation expansion, meaning investors were willing to pay more for the same earnings, specifically linked to AI optimism. Things like the launch of that DeepSeek R1 model in January 2025 were cited as triggers.
So investors basically said, we don't believe in the broad Chinese economy right now, but we do believe in the AI story for specific companies.
Precisely. The data shows a massive split. If you look at HK-listed stocks, seen as AI beneficiaries, their performance shot up, maybe 45% cumulatively after that DeepSeek news hit.
45%. Wow.
But the broader MSCI China index, the one covering lots of non-AI sectors, it lagged significantly.
So deep skepticism about any general economic turnaround. They're just chasing the hot theme.
It suggests that, yes, investors are making very targeted, high-conviction bets on specific tech winners,
Yeah.
primarily in AI, while remaining wary about the rest of the economy, especially things tied to consumption or property.
But even that AI bet, it carries its own risks, doesn't it? We see huge spending plans like Alibaba mentioning $52 billion for AI capex. That's massive investment.
Huge investment.
But turning that into actual profit, that takes time. And it's happening within that same Chinese regulatory environment we just discussed.
That is the core risk with the AI story itself. Yes, AI promises huge productivity gains for the economy. That's the bull case.
Yeah.
But there's a real risk that rapid AI adoption could displace workers faster than new jobs are created. It could potentially increase unemployment, at least in the medium term.
And if that happens,
If unemployment spikes, particularly among younger workers, the government's priority will inevitably shift to social stability. And that likely means more regulation, perhaps targeting the very AI companies that are booming now, maybe to slow down deployment or manage the social impact.
so the AI rally could ironically trigger the next round of regulatory intervention that hurts those same stocks.
It's a definite possibility, a risk loop investors have to consider.
Okay. So bringing this all together after our deep dive, what's the main takeaway for you, the listener, trying to make sense of China's market?
I think the synthesis is this. Stock Connect, the mechanism itself, has largely done its job. It built the essential financial plumbing, the infrastructure for two-way capital flow. That's a real institutional achievement.
The bridge is built.
The bridge is built. But whether China's market achieves true global vibrancy, that really depends on tackling those deeper structural challenges we talked about.
Things like policy predictability.
Yes, consistency there, demographic headwinds, and getting corporate governance standards truly up to global best practices, especially for the SOEs. Until those are resolved, the market potential remains capped, in a way.
So this understanding means you, the listener, can't just buy China. You have to be incredibly selective.
Exactly. It's clearly a high-risk, high-reward environment. Policy shifts matter immensely. Structural growth themes like AI are powerful drivers, but broad caution is probably still warranted until there's clear, sustained evidence of recovery in the core economy consumption, the property sector stabilizing.
Makes sense. Selectivity is key.
And maybe one final provocative thought to leave you with. Consider how China's economy is fundamentally changing shape.
How so?
Sources are pointing out that China's digital economy core sectors, think e-commerce, cloud, AI, fintech, now generate something like RMB 48 trillion in revenue.
48 trillion RMB. Okay, that's a huge number. How does it compare?
Well, compared to the old economy engine, property development and related construction,
Yeah.
that's estimated at around RMB 37 trillion.
Wow. So the digital economy is already significantly larger than the entire property complex.
Numerically, yes. The engine of wealth creation seems to be shifting decisively towards digital. And AI is only going to accelerate that shift.
So the question is?
The question is, if the real economic engine is now digital, how long will it take for global investors to fully reprice the market based on that new reality? How long until the old narrative, obsessed with property cycles and debt, gets left behind?
When does that paradigm shift happen in investor minds?
Exactly. Recognizing and timing that potential re-rating based on the digital transformation. That might be the next huge decision point for anyone investing in China.